Hi, I'm Alex Wagner, and today I'm going to talk to you about timing your entrance onto the investor market for a buy-to-let Paris home. The reason I'm thinking about this at the moment is because I was discussing this with an investor client, well, a prospective investor client last week, and he was wondering, seeing as Paris has globally, overall, lost 1.5% in prices last year. Could this be the start of a downward trend? Does that mean I should wait to buy? Maybe wait a year or two for prices to drop? That way I could maybe get a bargain. Maybe that means I can get more capital gain in euros or dollars when I come to sell later on. And well, the thing is, would be completely logical if the investor were going into this short term to flip his property and make a quick profit, obviously. However, that's not what our investors are going for. You see, as an investor going into a buy-to-let Paris home, you're looking for a pied-à-terre home which you can use yourself for a number of years. You're looking to profit from monthly monthly returns on your rent, because you get strong rent every month. You're looking to hold the property over the long term, possibly use it for your retirement, possibly pass it down to your kids. Who knows, it might stay in the family. So in any case, you're in this for the long term. You're looking to hold the apartment for a number of years, maybe even a decade, maybe even several decades it'll stay in the family, who knows. So, given that, well, what are the long-term prospects in Paris? Well, there are four ways of looking at this really. Four factors that influence Paris prices. Paris is the capital of France, and so obviously it's going to be popular with the French. And as for international clients, I can't see Paris falling out of favour. It's quite unique in the world in terms of atmosphere, soul, history, architecture. And given that half the world is waking up at the moment, I'm thinking of the Chinese, well, I don't think that centre of attraction is going to stop anytime soon. Now, compounding this is a general trend towards urbanisation. Now, this is in France, but not only in France. Countrysides are tending to get emptier and emptier, while cities tend to get more and more full, more and more dense. So that's a long-term trend. Now, in addition to those two fundamentals, we've got two further elements of scarcity. Well, first of all, Paris is geographically limited. It's actually a small capital city, as capital cities go. And there's not going to be any more Paris because it's strictly limited in size by the périphérique ring road that goes around it, and beyond which are the less desirable suburbs. So there's not going to be any more Paris, which makes it scarce. Now, another scarcity factor is that they're not going to make how do I say this? They don't make them how they used to. What I mean by this is what people really want in Paris are historic buildings. Haussmann buildings made of carved stone facades, which have the kind of mouldings that you can see behind me on the wall here, that have hardwood floorboards, high ceilings, French windows. All these factors of charm and warmth that make Paris unique. There's not going to be any more 100-year-old buildings in Paris, obviously, by definition. So that's another big scarcity factor. So for what reason would you come into the market now? Well, it's quite easy. You see, given that the long-term perspectives for capital gain are good, they're solid. Oh, and by the way, I should mention that, just as an aside, Paris has always, on the long term, appreciated. Of course, there have been cyclical ups and downs, like in any investment market, and unlike some investment markets, Paris has just always gone up since records have begun on the long term. So it's quite a solid bet. Now, what we were saying is, so why come into the market now? Well, it's quite easy. Given the good long-term perspectives, what you want to look at is your yield at time t right now in the present. If your yield is satisfactory, then you can go ahead. If your yield is not satisfactory, then you should wait for prices to drop. It's quite easy. Now, yield today is about 4% for our investors on a buy-to-let Paris home. That, in today's difficult economic environment, is good, especially as we're not talking about a 4% peak just 1 year. We're talking about 4% that you can count on reliably in a stable way, year in, year out. So that's what makes this rental yield good. Now, this question of when to come into the market is now a good time. It reminds me of when I started myself, not when I started down at Carte, but when I started investing myself in real estate. This was in 2004, 2005, and incredible though it seems in today's market, we actually thought that Paris was hitting a peak in 2004, 2005. I say incredibly because Paris has risen by about 15%, 1.5 per year since then. But back then, press articles were saying Paris was going to drop, which is reasonable enough because prices were a record high back then, even though they've doubled since in the intervening 10 years. But they were very high, and so I was thinking, well, is it prudent of me to go into the market now? People are expecting prices to go down. Shouldn't I wait to buy at a lower price? Well, my reckoning was, I'm not going into this to sell short term. I'm happy with the rental return that I can get at time t, so I can go ahead. What's going to happen? Either prices will go up and I'll be happy because I'll get capital appreciation, or prices will go down because we'll come into a downward cycle, and in which case I'm not going to sell anyway because I'm in this for the long term, so it doesn't matter. And hey, if prices go down, that means maybe I can buy another apartment to hold for the long term, so maybe it would be nice for prices to go down anyway. So essentially I framed it as either I win or I win, so I can go ahead now at time t. That was back in 2004, 2005, and of course I haven't regretted it, and I've bought several since. And I would have bought several since whether the market had gone up or down. You see, the short-term trend just isn't relevant. This reminds me of an expression that traders have. It's hard to catch a falling knife. Now, catching a falling knife, it's kind of an analogy for spotting the bottom of the market, grabbing the shares while they're cheapest, while they're dropping. And they call it a knife because it's dangerous. I mean, it's dangerous, it's difficult, because when you're a trader, or in fact any kind of investor, well, you're looking at the right-hand side of the price curve, the extreme right-hand side, and it's notoriously difficult to predict which way it's going to go. The reason it's difficult to predict is because even if you're in an upward trend, you're going to get downward blips occasionally. That's just the nature of any investment market. And likewise, if you're in an upward trend, you're going to get downward blips. I can't remember if I said the opposite earlier, but you see what I mean. You get these little blips within the long-term trend that make the market very difficult to predict. So was last year's minus 1.5% a blip that's going to then get rubbed out by a market that's going to pick up again next year? Or was it the beginning of a longer, several-year-long downward trend? I don't know, and to be honest I don't care, because I'm not coming into this to sell. I'm coming into this to hold for the long term and to benefit from a good yield at time t that satisfies me with respect to whatever else I could do with my money. Now, this reminds me of a conversation I had about 5 years ago with two real estate friends of mine. They each have a real estate agency in Paris, and they were saying, well, Alex, shouldn't you maybe wait a bit to buy your next apartment, because it's going to be like a big sale in Paris, the real estate market next year. That was their words. Une grande braderie means a big sale. Prices are going to fall down. There's going to be a big price correction. It wasn't just them saying it. The general public economy magazines, investment magazines, were saying this too, that the price trends, upward price trends, could not be maintained indefinitely, and that it was bound to crack one day or another. But nevertheless, I applied these same rules. I looked at the long-term trends, which were favourable. I looked at my rental yield, which was good at time t, and so I went ahead and bought. And this was 5 years ago. Prices have gone up. If they'd gone down, I wouldn't mind either, because I'm not in this to sell. And in fact, if they'd gone down, maybe I would be thinking about buying another one. So again, it was a case of either you win because prices go up, or you win because prices go down in the short term, which doesn't matter unless maybe it tempts you to buy another one. So I guess the lesson I'm trying to communicate here is, look at it this way. The fundamental point is that the biggest risk of all is being immobile, not pulling the trigger, not doing anything, and then gradually getting priced out of the market. Look, by micromanaging, by micro-optimizing where you come into the market, at what price you come into the market, you take the risk of not acting at all, of not coming into the market at all, and that's a much bigger risk than of slightly sub-optimizing your capital gain. It makes me think of a friend of mine. Now this goes back about 10 years. He's called Guillaume, and he works in finance. He works in financing of fusions and acquisitions of companies, so he knows a thing or two about money and finance. And Guillaume and I were having a discussion 10 years ago. We both at that stage didn't yet own property, and I wanted to buy my main residence, and Guillaume was thinking about this too, and we didn't have the same opinion, because Guillaume was thinking, well, the market's really high right now, why don't I wait for it to drop, that way I can get a bargain? And I was thinking, well, yeah, but I'm in this for the long term. I just want to get a foothold into the market. If it goes up, then that's fine, I'll get capital appreciation. If it goes down, that's fine, because I'm not buying for the short term, again. And this was the same rule whether it's my main residence to live in or the investment apartments that I subsequently bought. What's the result? Guillaume, 10 years later today, still hasn't bought his home in Paris where he lives. He is still rents from a landlord. Now he has bought some real estate because he's bought his second home in the countryside, but that's hardly the same for the reasons we were talking about before. His long-term outlook for capital gain is poor because countrysides are getting emptier. There are no scarcity factors. On the contrary, country houses in France in beautiful areas are highly abundant, contrary to Paris apartments, especially those built 100 years ago. So all this to say that it's not to blow my own trumpet here, it's to illustrate the danger of not coming into the market because you're trying to micro-optimize it. Guillaume back then was trying to micro-optimize his entry into the market. He was trying to catch the falling knife. Well, it wasn't falling at the time, but he was trying to wait for the knife to fall and then to catch the bottom of it, the bottom of the trend. Whereas I decided to go ahead, and now that means I own several apartments in Paris, which I'm holding for the long term, which will either in the next few years go up, and that's fine because I get more capital gain, or they'll go down, and that's fine because I'm holding anyway, and frankly I'd quite like it for the market to go down, that way I can buy some more. So that, to conclude, is the risk that you really want to avoid. You want to avoid the risk of not entering the market at all because you're trying to micro-optimize your entrance, and you want to pull the trigger if two factors are aligned. Long-term capital gains, because that's why you're coming into this, you're coming into this for the long term, and of course your rental yield at time t. If your rental yield is satisfactory and 4% is good in today's market, and your long-term perspectives are good, then you can go ahead and pull the trigger and not take the risk of waiting and being left out of the market. Thanks.